Interest rate risk management. First concept, forward rate agreement. Forward rate agreement means forward contract on interest rate. It is done over the counter. FRA 3/9 means after 3 months, first 6 months, loan taken after 3 months, first 6 months. First number will represent after, difference will represent for. First number means here 3. Difference means 9 minus 3, 6 months. 6 months is for and 3 months is after. Floating rate, have reset period. Upside betting. Upside betting means increase. In case of increase in interest rate, we will take long side by FRA. In case of downside betting, that means decrease in interest rate, we will do short and sell FRA. In case of short, sell FRA. Rate with FRA bank is fixed. This is the ultimate outflow of interest. FRA for hedging. FRA can be used for hedging and speculation and arbitration also. Arbitrage opportunities also. FRA for hedging. In case of FRA for hedging, net settlement amount equals to N into RR minus FR into DTM divided by Y whole divided by 1 plus RR into DTM divided by Y, where N is the notional principal, RR reference rate, that is the rate on the date, FR forward rate, DTM date till maturity, it is the period of forward contract, Y days in an year. FRA for arbitrator. In such a case, theoretical FRA will be calculated. Theoretical FRA equals to bigger factor divided by smaller factor. Steps for calculating FRA in case of arbitrage is rate divided by 12 in 2 months divided by 100 plus 1. Finally, we will calculate the theoretical FRA. Theoretical FRA equals to bigger factor divided by smaller factor. Actual FRA is greater than theoretical FRA. Then it is overvalued, sell FRA, and vice versa. If the actual FRA is less than theoretical FRA, it is considered as undervalued by FRA. Interest rate guarantee or fraction. Forward rate agreement versus fraction. Interest rate guarantees. In case of forward rate agreement, there will be no premium. In case of fraction or interest rate guarantee, premium will be paid in advance. Next, in case of forward rate agreement, payment will be done in 2 sides. In case of gain, FRA bank pays to the customer. In case of loss, customer pays to FRA bank. But in case of a fraction, only one side payment will be there. Only in case of gain. In case of gain, FRA bank will pay to the customer. In case of loss, there will not be any payment from the customer to FRA bank. Next, interest rate futures or euro-dollar future. It is the future contract on interest rate. Quotation will be 100 minus LIBOR. Interest rate is inversely proportional to T-bill price. If rates decreases, buy T-bill. If rates increases, sell T-bill. That means if rates are going to decrease in the future, buy T-bill. If rates are increasing in the future, sell T-bill. T-bills are interest-bearing securities. Here, in case of a interest rate future or euro-dollar future, betting is done on T-bill securities. Interest rate future equals to 100 minus interest rate. Interest rate future is inversely proportional to interest. Default interest rate. Interest rate future is inversely proportional to interest rate. Default lot size of interest rate futures in India is 2000. Next, financial swaps. Under that first one, generic swap. Generic swap is also called as plain vanilla swap. Here, swapping will be done for fixed to floating and vice versa, floating to fixed. At last, netting will be done. Here, in case of plain vanilla swap or generic swap, one leg is fixed and one leg is floating. Here, effective cost equals to outflows minus inflows. Next, overnight index swap. In case of overnight index swap, the floating rate, that is MIBOR, daily compounding will be done for floating rate. Effective cost equals to desired borrowings minus share in net gain. Next, in case of two-party swap, effective cost equals to desired borrowing minus share in net gain. Periodical fixed interest. How to calculate periodical fixed interest? 1 minus DL divided by summation of DN, where DL is the discounting rate of last year, summation of DN is the cumulative discounting factors. Next, cheapest to deliver bond. If IRF position, interest rate future position is short, then profit or loss will be IRF, interest rate futures, into conversion factor minus current market price. In case of long IRF position, profit or loss will be current market price minus interest rate futures into conversion factor. Next, value of swap. Value of swap equals to floating rate of bond value minus fixed rate of bond value. Quality spread or possible swap gain equals to difference in fixed rate minus difference in floating rate. Caps, collars, futures. Cap is nothing but a call option. Floor is nothing but put option. Collar is nothing but a combination of cap and put, call and put. That is cap and floor. Combination of cap and floor is collar, and floor means put option. Cap means call option. These three, caps, floors, collars, are used for speculation and hedging. Format for sum calculation, period, MIBOR or LIBOR, whether accessed or lapsed, payoff. Net payoff equals to gross payoff minus premium.